Welcome back. Today we are diving into a financial analysis on Applied Digital Corp, APLD.
hmm
The piece lays out a really resounding strong buy thesis. It's projecting some pretty significant upside based on their pivot to AI infrastructure and some recent wins.
Right.
And what stands out right away is just how clearly it lays out the consensus rating. That $43 average price target and the pillars for the bull case.
And that foundation is excellent. It immediately convinces you there's a high floor for the valuation.
That APLD could be a doubler in the next year.
So a key theme here seems to be that they've removed a lot of the old execution risks.
Yeah, the analysis really highlights that Polaris Forge 1 milestone, achieving ready-for-service status.
A huge proof point.
Huge. And you combine that with the revenue visibility from those massive contracts, the CoreWeave deal, the hyperscaler lease. That's 600 megawatts. It makes a powerful case.
It's the essential starting point. But if we're going to maximize the impact here, we have to move past just celebrating the win. We need to strengthen the argument by rigorously stress testing the key assumption.
And that assumption is client stability.
Exactly. Client stability.
Okay, but let's stress test that a bit. The analysis cites the sheer scale of the contracts as a huge positive. 600 megawatts leased out. Doesn't that sort of zero out the demand-side risk for the next 15 years?
It does, for demand, yes. But it dramatically elevates the concentration risk. And that's the weakness. The analysis just doesn't explore the flip side of that coin. You've got all this capacity, 600 megawatts leased to basically two big clients.
Right.
So for 15 years, the entire valuation is hanging on the financial and operational health of CoreWeave and, that rumored hyperscaler.
So if one of them stumbles,
the whole $43 price target becomes instantly vulnerable.
that really highlights the hidden fulcrum supporting the entire model. If you're building a case that a stock is going to double, you absolutely have to tackle the biggest threats head on.
Precisely. So the suggestion for improvement is to integrate a dedicated section that mitigates or at least directly addresses this concentration risk.
You have to show the reader you've thought about it.
You have to show them it's been anticipated, it's been defined, and it's been planned for contractually.
Okay, so let's get specific. How can they actually weave that discussion in? It's not enough to just say the contracts exist. We need to talk about the resilience.
Well, one core approach is to just analyze the contractual protections themselves.
Okay.
The piece should detail if there are termination clauses or, usage minimums built into these leases. Is the protection robust?
Meaning, if a client scales back for whatever reason, does APLD still collect, say, 80% of the rate or 100%?
Exactly. Investors need to see documented proof that this revenue is sticky even if utilization dips.
And building on that, the other side of the risk isn't just contractual, it's operational. How fast can APLD recover if a major tenant actually defaults?
Which leads you right into scenario modeling.
The sharpest tool in the box for this kind of analysis.
Absolutely. The writer needs to model a downside scenario. What happens if one of these two clients, say 5 years from now, has a major strategic shift or even a bankruptcy event?
You'd have to model the hit to the valuation target.
And then, crucially, how quickly could you find new tenants for this really specialized liquid-cooled capacity?
See, that's where the specialization becomes a kind of double-edged sword, right?
Exactly.
If this is so cutting edge, is that capacity actually fungible on the open market? Wouldn't releasing it take years given the tech requirements?
That's the challenge they need to explore. This isn't like releasing standard co-location space.
No.
To find another client who needs 300 megawatts of liquid-cooled capacity right now. You're looking for another hyperscaler with a matching tech stack and a massive budget.
So if the analysis can argue there are, say, 5 or 6 other companies that could absorb that capacity within a year, the risk is manageable.
But if that market is really only 2 or 3 other players, the risk is severe, and the analysis has to reflect that potential downtime.
And this whole discussion of execution risk, it doesn't just apply to the clients. It applies to the capital structure itself. The analysis rightly points to that $5 billion Macquarie financing vehicle as a huge strength.
It is a strength, but we need to bolster the discussion of that deal. It should be less about its existence and more about its implications for ongoing execution risk.
Okay.
Polaris Forge 1 being ready is a fantastic first step, but this build-out happens in phases, across multiple sites.
So you need to look beyond the initial win and examine the continuous requirements tied to the money.
Precisely. What happens if construction timelines are not maintained?
Delays in power, permitting?
Supply chain bottlenecks? Anything. The funding could get complicated. We need to know that the debt covenants can absorb minor delays without triggering, higher interest rates or a refinancing crisis.
Because that directly impacts the cash flows that underpin the whole valuation.
It all connects. Stress testing these dependencies is what will really justify those aggressive APLD price targets.
That gives us the internal scrutiny. Let's shift our focus to the second major area for improvement, which is really about placing APLD within its external competitive environment.
Agreed.
The material makes a strong case that APLD is a critical pick-and-shovel play for the AI revolution. It supports this by pointing to the Macquarie financing, the debt offering, which, really put those shareholder dilution fears to rest. They've told the internal story extremely well.
And while the piece is successful in arguing APLD is executing internally, it really needs to broaden the context. It has to position the company within the competitive landscape to truly justify that high-end street target of $56.
I see the problem. So they've got the right angle, the pick-and-shovel thesis. But the weakness is a narrow focus just on internal wins.
Correct. It's so focused on APLD's ready-for-service status and its financing, but it lacks any external context. There's no talk of barriers to entry, no real comparison to competitors.
Especially the big US hyperscalers who are also building out AI infrastructure like crazy.
Right. And that narrow focus, it limits the originality of the thesis. It doesn't answer the key question. Why is APLD a better shovel than just building the shovel yourself?
And if you're trying to convince someone that APLD deserves that street-high target, you have to prove its model can't be easily replicated by, a Google or an Amazon who have basically infinite capital.
So the core suggestion here is to strengthen the argument by explicitly defining APLD's competitive moat.
It's defensibility.
Exactly. It's defensibility against in-house build-outs by the big tech giants. It needs to answer the fundamental question. Why are these powerhouses choosing to lease from APLD instead of just building it themselves?
So we need concrete examples of a genuine, sustainable competitive advantage. It has to be more than just, we're focused on AI.
Absolutely. First, compare the specific economic advantages. What is APLD doing maybe in terms of speed to market, or navigating regulations, or securing cheap power that is truly difficult for a huge entrenched company to replicate quickly?
Right. A financial investor needs to see a real, defensible economic arbitrage there.
If APLD is providing a solution faster and cheaper than Google can do it internally, that's a powerful moat.
That's fascinating. But we also have to think about the strategic risk from the clients themselves.
That's a crucial line of questioning. You have to examine the type of clients APLD is attracting, like CoreWeave, which is backed by NVIDIA. Is this specialized niche of serving the AI cloud providers, is that defensible long-term?
Or is APLD just filling a temporary capital gap?
Exactly. Explain that capital gap idea a little more.
Well, it goes back to that 15-year lease. If CoreWeave is leaning on APLD for capacity right now because APLD can get financing and build faster, what happens when CoreWeave achieves massive scale and liquidity on its own?
Could they be tempted to just internalize their capacity needs then?
You have to explore that risk. Maybe look at industry precedent where large customers eventually move from renting to owning their infrastructure. The argument has to be that APLD's specialization is a long-term advantage, not just a short-term financing benefit.
That raises one essential final point. These contracts are for 15 years.
An eternity in AI.
It's the fastest moving sector in technology. The risk of technological obsolescence has to be addressed directly.
Especially for specialized infrastructure like this.
It is non-negotiable. I mean, given the rapid cycle of AI hardware and cooling tech, we're moving from air-cooled to liquid so quickly. The analysis has to talk about how APLD plans to manage that turnover.
A 15-year static lease just seems to conflict fundamentally with the pace of AI development.
It does. I can just imagine an analyst looking at those 15-year cash flow projections and just discounting them aggressively because they assume the infrastructure will be obsolete in 5 years.
So, does APLD have modular designs? Can they swap out cooling systems easily?
Are there contractual provisions for funding upgrades to keep the facilities state-of-the-art? Answering that question solidifies the long-term value because it proves APLD can justify those high future cash flows.
Without a clear plan for that, the pick-and-shovel thesis becomes more of a technological time bomb.
It really does.
This has been a really insightful exploration. We've taken what is already a strong thesis and found the two main pillars that need to be fortified to give it unassailable conviction.
Yeah. We focused on the internal risks first, really challenging the stability of that high client concentration.
The single biggest point of failure.
And demanding clear, defined mitigation strategies for it.
And second, we broadened the context. We pushed for sharper context on the competitive landscape.
That means defining a clear, sustainable, competitive moat against the hyperscalers.
So, to summarize the actionable steps for the listener, first, integrate specific mitigation scenarios for that client risk. Detail the contractual protections, model retenancy speeds.
Okay.
Second, define a clearer competitive moat. Compare APLD's unique economic and tech advantages relative to the giants, and make sure the analysis addresses the risk of technological obsolescence over that 15-year contract life.
Implement those suggestions, and the justification for those APLD price targets moves from compelling to truly high conviction. We encourage you to make those revisions and submit the analysis again for a follow-up. Until next time.